Knowledge is power. Make an impact by learning more, or hire us to do it for you. Let us focus on what we do best so you can stay focused on what you do best. Find all of our options under services, one-to-one training, subscription-based training, or accounting and business consulting. Improve cash flow by improving accounts receivable turnover. Easier said than done, you say. You're absolutely correct, but that doesn't mean it can't be done. Just means it's easier said than done. So let's talk about this. First of all, we have to understand it. What is accounts receivable turnover? It's the time it takes from the day you've invoiced somebody to the day you get paid. And I've got a sheet here that we were using in the cash flow show, and I was doing that for a period of time there with Mike Milan. With some basic numbers keyed off of a balance sheet. So we want to look at our accounts receivable, which is right here, $654,000. And we want to look at our net credit sales, which in this case, in this example, $7,100,000. And we can go over to our financial gap because the accounts receivable turnover is part of that bigger calculation. And you can see that if you take the accounts receivable divided by the net credit sales and then multiply that by 365, because before multiplying it out, you're really getting like a daily average. So multiplying it by 365, you get the average days it takes to collect a receivable based on this information. So 33.62 days on average might be good, might be terrible. Depends on your industry, but the bottom line is if you're looking for ways to improve your cash flow, it doesn't really matter how it compares to anything other than where you want it to be versus where it is now. So let's say we'd like to get AR turnover down to something closer to 2 weeks, right? The question again is, how do we do that? Well, when I did our Authentic Accountant podcast, when Eric and I interviewed Mike, he shared a really good story with us about a previous business of his in which he was struggling with his own cash flow, and he was at the point where he was going to have to shut the company down because he didn't have enough money to make payroll, and he hadn't paid himself in months. And he called the client and appealed to the client in a really interesting way. And Mike has a very clever, colorful way of putting things. It's one of the things I love about him. And what he said is that he explained to his client, his customer, that he needed them to think of him as an employee and not a paper towel. In other words, he needed them to treat him that way when it came to paying him. That was his way of politely appealing to them to pay him faster. And it worked, probably because he didn't just go in there and slam the client and say, you need to pay me faster. He had a reasonable, normal conversation with the person and presented himself as a human being and not a machine. And went in and just said, hey, I need your help. I need to get paid faster. And he did it in a way that painted a picture, right? That made it pleasant, if anything, for his customer probably to consider what he was asking them, right? Couple other ways to do it. The best way, ideally, is to get paid up front. Also easier said than done. But as I mentioned in the write-up, at one point when it was unheard of in the accounting industry, I made a decision to do that with Nerd Enterprises because I got tired of chasing, and it was always the same people over and over again. I was chasing to collect money. So I just flipped things around and started telling new customers coming in that I needed to get paid up front. I needed a retainer to be paid, and in those days I was still billing by the hour, so I would just charge the hours against that retainer. I actually got the idea from a lawyer client of mine. I said I should do it just like he does it. Get paid up front, bill out the hours, take that out of the retainer funds, and then bill them to replenish the retainer. And to my surprise, every single client just about that I presented this to said they respected it. One, they respected it. Two, they said they should be doing the same thing. So get paid up front. It might be easier than you think to do it. And the trick is, don't worry about your existing clients. Try it on your next new client and see if they don't end up respecting it and saying, absolutely, no problem, right? Because as I always say, if they want you to do the work right away, shouldn't they be willing to pay for it right away, right? So, again, getting paid up front obviously solves the whole problem. My accounts receivable turnover will very quickly go to zero, right? Now, the other thing is you could offer a discount for timely payments. I don't love doing that. I don't like discounting things in the first place. I definitely don't like feeling like I need to discount something just to get somebody to pay me on time, especially when I did the work, right? Another thing is we can go to cashflowtool.com, and because now you're wondering, all right, well, how do I stay on top of this calculation? Cashflowtool.com makes it very easy to do that, right? You go in here, and cashflowtool.com connects with QuickBooks or QuickBooks Online or QuickBooks Desktop, and as you can see, it's showing me that my average days to collect. Now, I have very few people that I invoice. It's very rare, so this is based on a very small amount of data, because most of my customers, as I mentioned, do pay up front. But there are occasionally projects and other things that I have to invoice, and on average, it's taking them 33 days to pay me. Interestingly, my time to pay my vendors on average is 23 days. So that suggests a real strain on my cash flow, because I'm paying my people faster than I'm getting paid, according to this data. So that's something to consider, and we'll get into accounts payable turnover in a couple of weeks. But for now, I just wanted you to see that when you look at this side by side, it's really helpful to see this. So ideally, what we want to do, if nothing else, as our target is get this below 23 days. If this is normal and typical for me for my payables, then I want my receivables to get paid faster than I'm paying my payables. Ideally, perfect world. Right? So cashflowtool.com is a great way to monitor and manage and keep on top of this. What's more is, if I'm working with a team or as an accountant where I can use this tool with my clients, I love this because I can click here now and I can make a comment and I can broadcast it to all my team members and discuss how can we get this below our AP turnover is 23 days, how do we get our receivables turnover, and I can start having the discussion and make the suggestions about moving over to a getting paid up front model, or otherwise who can get on the phone with our clients, who has time to get on the phone with our customers, or my customers in my case sometimes, who can get on the phone with them and see about finding ways to motivate them to pay us faster. That, my friends, is how you can improve cash flow by improving accounts receivable turnover. As always, I hope you learned something, had some fun along the way. I hope you're having an absolutely fantastic day, and I look forward to seeing you on the web.